Okay, sorry about that, everybody, but good afternoon and welcome to today's webinar, Passive Investing in Apartment Buildings Through Your Retirement Plan with Next Generation and the Apartment Queen Investments. I am Erica Figueredo. I'm the marketing specialist here at Next Generation, and we have an exciting presentation for you today. But before we get into that, I wanted to go over a few housekeeping items and introduce our speakers and give you a bit about Next Generation. So as always, today's session is being recorded. If you didn't have a chance to make it live, it will be available for on-demand viewing. And if you are here with us live, welcome. If you want to watch it again, you guys will get the recording at some point tomorrow. And with that being said, everyone today joining in will be on mute. And if you have any questions, please put them into the Q&A tab on your GoToWebinar control panel. You can also paste them into the chat box. But what we would like you guys to do with the chat box is just quickly introduce yourselves. Let us know who you are, where you're from, and anything else you may want to add, what brings you here today. We really want to hear from you. We want to keep this engaging and very conversational. So as we get into it, I will start with introducing our speakers. So first, we have Brittany Melville. Brittany Melville is our Director of Marketing and Sales. Brittany applies her extensive experience in direct sales, marketing, and customer relationship management at Next Generation. In her role, she develops and oversees the implementation of our marketing strategy across all media and works with our team to support sales initiatives. Brittany's accomplishments throughout the years include designing and executing lead generation strategies across multiple channels, developing and nurturing multi-million-dollar sales pipelines, enhancing digital marketing outreach, creating educational content, conducting market and competitive analyses, training sales personnel, and improving internal processes to support sales. Prior to joining Next Generation, Brittany held positions at Convergent Revenue Cycle Management, Inc., and Altria Group Distribution Company, which was formerly Philip Morris USA. Brittany graduated cum laude with a BS in Marketing and Business Management from Boston College and is certified as a self-directed IRA professional, also known as SDIP. Most of our staff are SDIP designated, so many of our employees are also self-directed IRA professionals, which just means that they have additional knowledge in the area of self-directed IRAs. Brittany and her husband currently live in Branchburg with their cat, Leo. She also owns a rental property at the Jersey Shore, and in her free time, she enjoys dancing, working out, playing piano, cooking, reading, and cheering on her favorite football team, the Philadelphia Eagles. And we also have our co-host, Kaylee McMahon. Kaylee is the owner of the Apartment Queen and the Apartment Queen Investments. So Kaylee has purchased over $2 million in real estate as key principal. She has sold over $3 million in residential real estate before transitioning into her current full-time syndication role. Originally from Portland, Oregon, host of InvestHer Dallas, she has started a podcast called Number One Leading Ladies, where she interviews kick-ass women who are disrupting their industry and the real story of how they got where they are. Kaylee has done home flipping as she feels that to be truly confident and giving advice to clients about buying, selling, flipping, and investing in real estate. One should never take advice from someone who has never gone through these things themselves. Kaylee has completed continuing education in home comparables, appraisals, real estate investor representation, investment and wealth creation, Legal 1 and 2, broker responsibility, property management, marketing and web development for real estate companies. She continues to learn for fun constantly. I like that, and I do that as well. Some of her completed subjects and courses have been apartment value add strategies, syndication methods with Joe Fairless, apartment mastery boot camps with Rod Cleef, rat race to retirement seminars with the Sumrock Group, She's constantly reading on negotiating tactics, Chris Voss, Never Split the Difference, How to Buy and Flip Businesses, which are sick, and much more. She has completed GRI Marketing for Sellers. GRI is the Graduate Institute for Realtors, and it is a distinction that shows Kaylee is committed to the success of getting you top dollar on your investments. The entire backbone of what gets Kaylee out of bed every day is her why. This is something she will share when asked personally about it, but a 30,000-foot view, it is to create independence and space for those experiencing codependency and toxic relationships, which hamper their ability to visualize and then manifest what their amazing reality truly could be. Her company culture models this why and is changing the face of multifamily to bring more women into the light as powerhouse operators, key principals, and commercial brokers. Thank you, Kaylee, for joining us. And now to get in to a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. So these plans are a lot like the typical retirement plans that you'll find at a brokerage house like Fidelity or Charles Schwab. However, instead of investing in traditional assets like stocks, bonds, and mutual funds, self-directed IRAs allow you to invest in non-publicly traded alternative assets. So our administrative firm and headquarters, Next Generation Services, is located in Roseland, New Jersey, and provides the record keeping and tax reporting services for all our client accounts. In addition, we provide the educational content that you'll see here on today's webinar, as well as a plethora of other educational opportunities via our website, like our white papers, our blog, our newsletter. Everything is jam-packed with education that you can use to help get yourself educated on self-directed IRAs and the investments that it allows. So Next Generation Trust Company is located and chartered in Sioux Falls, South Dakota, and provides the custodial services for the assets that are held within our client accounts. So moving on to our very necessary disclaimer on what we don't do. Next Generation is not a fiduciary, so we do not provide any financial, legal, or tax advice. So any information that's provided on today's webinar is for educational and informational purposes only. And as always, we encourage you guys to consult with your trusted professionals to determine if this strategy or investment is something that fits you and your retirement goals. So with that being said, I will hand the floor over to our moderator, Brittany Melville, who will drive today's conversation. So Britt, over to you.
Okay, well, thanks everyone for sticking with us through that technical glitch earlier. Great to have you. Today, we're going to dive into talking about passive real estate investing and then some awesome strategies for either doing it tax-free or tax-deferred and some of the different vehicles that you can consider to, as Kaylee would say, do a kick-ass job here. So going through the registrations when you were all signing up, we asked what you were looking to learn. So we took those things into consideration and we're going to address as much of that as we can. And then, of course, any questions that we have time for. But let's jump in because we're running a little late. So, Kaylee, do you want to start out and let's just talk kind of high level about passive real estate investing and, you know, some of the challenges that investors face that might make the case for doing it passively. And then talk about, with that comes the options for crowdfunding, syndications, and limited partnerships and that sort of structure.
So say that first question again. Some of the things that might come along with passive investing as far as advantages or disadvantages or both?
Yeah, so why would someone want to get into passive investing in sort of like in the form of a syndication or crowdfunding approach? And like, what are some of the challenges people tend to come up against that would lead them to that path, if that makes sense?
Okay, got it. Okay, so a lot of people get into passive investing, I find, because they have a limit on the amount of time that they have, and they have a limit to what they're able to do when they're spending all of their time, like I am, you know, managing properties and fixing problems all the time, that you know, they just don't have a lot of time for their why in their life. And so a lot of times people come to a certain age, it's not always age, but sometimes where they're going like, what am I doing? Like, why do I keep either, you know, working this full-time job all the time, doing the same thing every day for years and years and years? There's got to be a better way to not just trade time for money. And then on the flip side, it's like at the later part of someone's life when they do have assets that have been accumulating over time, and they're not being utilized to the best that they can be, but they realize that they want to spend their life in a quality manner. And so basically entrusting somebody else that spends full time all day, every day, you know, doing what we do or what someone does that, you know, does RV parks or whatever the asset is that they're managing or sponsoring, they're able to work together to be able to utilize more of their time to pursue their why or pursue whatever it is that they want to do in their life. And be able to still make money at the same time. So you're no longer trading time for money. I think a lot of people get to that point at some point in life. And then also, for example, it's a very similar situation like I got into where I was like, okay, I'm going to make active income, but now I'm paying a boatload of taxes on that. So even if I made $500,000 a year, if I'm losing half of it to taxes, like, what am I doing? What's the point? You know, there's a book called Die with Zero that I'd really recommend everyone reading that talks literally about the breakdown of how many years of our life as Americans we typically end up working to literally just pay taxes. You know, it's on average a decade, 10 years of your life that you're just paying taxes. Essentially, if you were to be able to not pay those taxes by utilizing some of these types of strategies, there would be another option. And so that's kind of what we're going to cover a little bit about today. But then also, you know, going from active income, then going, okay, now I'm going to be an investor and now I'm going to flip houses and I'm going to do that. And again, it's still a very active job, but then being able to turn that investing into a passive rental, for example, then you're starting to get a taste of what passive income is. But then as a single family operator, you're still in charge of tenants, toilets, termites, and phone calls and whatever it is, there's a maintenance problem all the time. And so then it's still not passive income. It's highly unpassive income. And then again, you're still paying those high taxes on the active income. So if there's a way to turn it into passive, your tax bracket reduces, and then you have more free time. Like, why wouldn't you like that? So I think that's where people kind of end up coming to. They want more money, they want more time, and they want to have more balance in their life.
Yeah, that makes sense. And I can firsthand relate to the headaches of actively managing a property. Last week, our tenants texted us that the air conditioning wasn't working. And of course, it was like one of the hottest days. And they just sent us like a picture of our Nest thermostat with some random error message. And I'm like, I have no idea what that means. So, you know, then of course we're scrambling at night to try to find someone to get out there and look at it, and you know, just all the back and forth. It is definitely a lot of work. So I definitely see the appeal on the passive investing side. And then it sounds like too, there are a few different ways to reduce that tax liability, whether you're using personal funds and, you know, making those passive investments, or you decide to use a already tax advantage account like a retirement account as the vehicle for the investment. So we can talk a little bit about both of those approaches, and obviously I can chime in more heavily on the retirement account side, but I know that some of the attendees also wanted to better understand just some of the different options. So we mentioned K1 income. So for anyone who's not familiar, can you talk a little bit more about that?
So yeah, that's kind of what I was mentioning a little bit earlier. That's the tax form that you get. So it's just, you know, if you're like 1099 or W-2, or you have a certain type of tax form that you get at the end of the year, or that you're filling out to go get a job, W-9, there's just certain tax forms that you file with the type of employment that you have. So K1 basically is an income statement that shows that you make passive income. So it's taxed in a different tax bracket, and that does depend. This is a CPA question more than it is for me. Whether you are active as a real estate professional or whether you're in a totally different industry, because K1s can also do more for you than just say, okay, here's another thing I want to discuss. A lot of people maybe that invest for the first time in a multifamily or commercial deal, they get their tax statements, they're going, oh my God, it's a loss, there's a negative number. That's a good thing. So what happens is you get a K1, and basically you're supposed to be getting payouts when you're a passive investor, so mailbox money. But typically, like in our deals for the first year, we do the value add period. We're changing out all the residents. We're making sure that we're getting unstabilized property to a stabilized place. Then we know how much income or cash we're going to be getting every month, and we can count on it. So then we're going to distribute it because we're confident in how much that amount's going to be compared to what we assumed getting into the deal. So basically the K1 income, you're going to have a loss in our situation for the first year. So say if you invested this year, you waited 12 months, and then, you know, the next time that you get a K1 statement, it may have like negative 14 grand or something like that. So that, depending on your career and depending on a couple of other things, and, you know, do you have other passive investing activities that you're doing? It depends on quite a bit of things, but it could possibly offset your other active income. And then also, if you are like I said, a real estate professional, the K1 can also give you added tax advantages where you have no limit to your passive losses. So if you're taking those passive losses and you have a spouse, or I think now it's like a partner it's become a little bit more of a little more open to like who it applies to, but or who in your life it applies to. But essentially, it was originally like if you have a spouse or someone that you are closely related to, and you both are earning income, and then you say you've maxed out as much offset as you can do towards your active income, maybe you don't pay any active income taxes at that point, then the remaining amount of losses you can take against your spouse's or your partner's income as well, and help offset their taxes too. And I don't know off the top of my head what the real estate professional designation takes. So again, CPA question, I think it's like 750 hours a year of real estate activities. So that includes, like, if you're trying to get into deals, underwriting. It includes drive-bys in the car. It includes, you know, you're on a trip and you take a stop somewhere. It includes research online, all kinds of different things. Not necessarily that you have to have a real estate license. So that's something that can also help, in addition to just the regular K1 passive income that, like I said, is taxed at a lower tax bracket. And then also it can help offset your active income taxes depending on what other activities that you do. So that's probably like my best explanation. And, you know, to go backwards a little bit on what we kind of were covering earlier about passive investing in a crowdfunding model versus syndication model. Basically, all of the idea here that we're covering with our passive investing is that it is a vehicle that's put together to pool money and to pool assets. And it can be done many different ways, but essentially the pooling of these things together. And then there's an operator or a person that is in charge of basically monitoring and executing the business plan for each asset that you're invested in, or each offering that you're invested in. And what it's called, I want to mention to y'all, the rule is that if there's over 2 passive people involved, so meaning if they have like one me and I've got a partner, that's usually a joint venture, a JV. If you've got more than 2 that are depending on, so maybe my partner is depending on me to run the whole show, and they found the deal, and so their income is basically passive at that point. And then if we took on another partner that also was participating, the rule is anything over 2 that are not the active people in the group, if they're depending on that operator for income, it's called a security. And so what we do is we file these registered offerings. It's an exemption registration with the SEC that allows us to be able to put together a company, put together this offering. They do depending on what kind we do, they do a certain level of vetting of the operators themselves, you know, not Reg D, but, you know, I'm doing a Reg C. It is different, but so it kind of gives you like a little bit of insurance that the SEC has looked through what we're doing, but mainly so that if there is ever a situation where, by the way, you're limited as a passive partner, you're limited of loss to just the amount that you invest. And so that's a big deal, because us as operators, we're signing on the loan. And so if things go bad, you know, not in Texas, it's a homestead state, but they can go after our assets. They can go after our other businesses. They can go after not our homes here in Texas, but in some other states they can. And so the limited partners never have that liability. If anything goes wrong, you cannot be found guilty of anything. You cannot be chased after for anything. And being an SEC registered offering, the group that's registered with them, basically, if there is a major problem, like for example, one time I've ever heard of, and I'm always very, I know I'm optimistic normally, but I've learned that investors also have to hedge their risk and be able to judge their risk. And so one time I have heard of somebody that was in the southeastern United States that basically had one partner that was newer, and they absconded with funds and left the country. So when that happened, then the SEC steps in and they try to go after that individual. And then there's agencies overseas that bring them back here and then try to recover funds for investors. But again, you're still only limited to the amount that you invested. So for example, if we put our risk on the line for like a $40 million deal, we're on the hook for that stuff. Y'all are not. So I just wanted to kind of like make that clear when it said something about limits to liability and the investors are involved. Again, your liability is limited as a limited partner. Sorry, I kind of went on.
No, that's okay. Very thorough explanation of the structure, the responsibility, and limits to the responsibility, which in a passive investing situation is, I would imagine, one of the benefits, right? In terms of in terms of IRAs participating in a structure like that, when we look at tax advantages, obviously, it's a little bit different because the IRA by its nature is already tax advantaged, right? So anything that the IRA acquires as an asset and then earns money on is going to either be tax deferred when those earnings flow back into the retirement account, or tax free if someone is using a Roth, which is an amazing tool for anyone that either already has one or is getting one started. Getting started early is great to get those after-tax funds in and then start building that value tax-free over time. So there are many IRA investors that opt to do these passive type investments, and the passive investments really tend to be the best fit for self-directed IRAs anyway, because most individuals that are investing, you know, they have full-time jobs or they have other whys, right? Like you said, they want to dedicate their time and energy to other things, and they just recognize that an IRA is another tool that they can use to get into these types of deals, whether it's really primarily they're doing it for the tax benefits and not being responsible you know, upfront for the tax, or also, and I know you and I have talked about this before, Kaylee, if they don't have the cash in their bank accounts to do these investments, and they happen to have, you know, a nice chunk of change in the retirement accounts, and of course they don't have to use all the retirement funds to do something like this anyway. It could just be a part of their portfolio. They could further diversify to include, you know, some of these types of investments, and obviously they remain passive. But they do have the ability and a little bit more control over choosing exactly what they want to invest in. So that kind of actually flowed into our next point. Go ahead.
Wrong, Brittany, but if I remember correctly, for a self-directed IRA, or well, IRA and self-directed IRA, I believe that you're limited to benefiting yourself when it comes to doing these transactions. So my understanding is also why passive investments are a really good fit for SIDRA investors or self-directed IRA investors, is because they also can't do business with their direct descendants. There's like a tree thing I always do. It's like your arm's length, like your family members, your businesses, things that directly benefit you, your lineage. You can explain that however you want to, but because that will incur tax if you do that. So when you invest with somebody else that you know, that doesn't happen. What's the words for that? Like you can't.
Sure. So the IRS, when you're using the IRA to invest in alternative assets, the IRA does have some limitation, or IRS has limitations. And they basically have a list of what they call disqualified people or disqualified entities. And those are defined as either yourself personally. So like Kaylee, if you had a self-directed IRA, you yourself would be disqualified from doing a direct transaction with your own retirement account. And then, as you said, that lineal direction, ascendants, descendants, and their spouses. So there are certain family members that don't fall into that description that actually you can invest with, like brothers and sisters, aunts and uncles, but anything in that up and down direction, so like parents, children, grandparents, grandchildren, if you think about it that way, those relationships are off limits. And to your point, when you're investing passively, it's a lot easier to avoid getting into some of those like sticky situations where you might be, you know, involving people that are disqualified. And if you, as an IRA investor, if you do something to trigger a prohibited transaction, there are steep consequences financially, and it's certainly not something that you'd want to do. So passive investing, arm's length, for the benefit of the IRA, long-term investment play is really the best kind of mindset to be in when using the self-directed IRA to be most successful. And it sounds like these types of investment opportunities fit for that. So, yeah. So we talked about using retirement account. In terms of not using a retirement account or other avenues that would award tax advantages, I know we kind of covered some of that. Is there anything else that we missed on that? And for those that maybe aren't really sure if they want to use an IRA, but maybe just invest with a regular funds and cash?
So it depends on like who you are and which type of IRA or retirement account or 401k, so solo 401k, like to what your method is to your madness, I guess. Like, so some investors are accountants and they understand how to balance their checkbooks very well, keep up with all of their expenses. So, you know, having a checkbook IRA would be something reasonable for that kind of person, but it's hosted at a place where the custodian they also have a set of records, so it's not just you, you know. So I guess for me, that's great to check things against things. For example, if it's a Roth or a different type of IRA, the custodian is involved with your transactions. So on my end, whenever we're working with an escrow company, or so that's what we do for crowdfunding, or whenever we're working with the company directly, so we're working with like Next Generation, I'll be in email with them if they have a certain department, you know, like private entities that works on talking to the investor and making sure their documents are filled out correctly with our offering documents so that the information is correct. That also helps for errors on the back end too, because for example, on our investments, it's a simple typo, a simple transposition or whatever of the kind of long name. I think it's like, you know, for the benefit of someone's, you know, account name. I'm going to get this all wrong, but it's a long name of the account number.
Right.
And so it's so easy to mess that up. So they help with getting the documents filled out correctly so that there's not an issue with like taxes or refiling with the IRS with a different name and just whatever. I've dealt with that before. And then also essentially housing your account, you know, so if there's questions, if you need more documents, it's like that back file that you would have at your house, but it's somewhere else that's safe, you know, and not, I don't want to use the word safe, but it's a large company, so it's not like, you know, they don't have a backup of files or you know, like me at my house, I just lose paper, my dog, you know, barfs on it or whatever. So it's nice to have like a set of like a backup to your documents that is the documents behind how you're getting income, how you're going to pay taxes or not pay taxes on them. So sorry, I kind of went on for a long ways, but you know, that's one thing that I see with you can get assistance, you know, with filling out these documents. And if it's your first time, I would definitely recommend doing that kind of until I start dealing with like accredited investors who have done this several times and they can just do it themselves. They really do need some assistance making sure everything's filled out right.
Right. Yeah. Yeah. The custodian is essentially like a middleman between the investor and then the retirement account that's going to be deploying cash into these investments. And by the custodian playing that role and processing these transactions on behalf of the retirement account, it enables the investor to use that account without having to take the money out. Because a lot of times we'll talk to people that are new to this and they're like, okay, so you're saying I can use my IRA to invest in real estate, so I'm going to take a withdrawal and then I'm going to, you know, use the cash. But if someone were to do that, obviously taking a withdrawal, especially before the retirement age, you're talking about penalties and taxes and so on and so forth. So this arrangement is such that the custodian is sort of, like you said, is safekeeping all of that documentation, doing the record keeping, and they're also responsible for, custodians are financial institutions that are regulated, or at least they should be regulated if they're saying that they're custodians. So they have obligations to report to the IRS, tax reporting. They have obligations to be audited on a regular basis by either you know, state's banking commission or any other entities that are a regulator overseeing them. So it is important to understand that and the relationship.
And y'all also do help keep us timely, to be honest with you. Like whenever we have to turn in our annual valuations of like what the investor's asset is worth, you know, I always forget that stuff. And, you know, my CPA doesn't remind me about that stuff, but the investors have to have that and you guys have to have that. And so like that also helps keep us timely with extra things that we need to make sure that are being reported.
Yeah, the record keeping. It's not the fun and exciting and sexy stuff, but it's some of the necessary stuff. So absolutely. So let's switch gears and talk about UBTI and UDFI tax for a few minutes. So I can talk about it sort of with respect to IRAs, but do you want to comment on any of your dealings with that in terms of how your investments are structured?
Yeah, so 3 different ways that I've dealt with it before. So before, when I have dealt with, so basically a debt leveraged asset is something that we are constantly involved in. So that means that we are taking a loan out on a property. So instead of putting up 100% cash, we're putting up 25% cash, on average would be normal, plus our soft cost to close. And so in that situation, the investors that do use certain IRA accounts are able, or are subject to a unidentified income tax, unidentified business income tax. I forget what it exactly stands for. Maybe that's
income tax. Yeah, unrelated.
I killed it. So basically, the tax, which from what I've been told, I haven't been taxed myself on that yet, but it could be, I've been told, up to 40% of your gains, and so that's something that investors can not have. Investors don't have to do. So even if you've invested in a company that's a debt leveraged company, I'm talking about like a company that was formed for an asset purchase, you can still change your account, to like a solo 401k, for example. So that's an opportunity to be able to change the account type and to not be subject to those taxes. Another thing that I learned about recently, and I'm not saying that this is like super common or normal, but I try to be as creative as possible with my deals. And so I have a surgeon, for example, that inputs like $1 million at a time. And so this guy, for that, inside of his IRA, so he invests in mezzanine notes, which are basically like a sandwich of a vehicle that invests into something, but he's got a portion of the sandwich. So a sandwich is usually like the lender that has a lien on the property, the equity investors that put in the cash to close. There's so many different pieces to the puzzle, and he's on the top of the stack, basically providing we call it either a soft pref, so a preferred equity position. So basically he's another lender, if you will. And so instead of taking part, like the passive investors, they get part, depending on the structure of the deal, they get to participate in refi. If there's a refi cash out, they get to pay, they get also a certain percentage of, and a certain split of any kind of capital event. So if we have rents that are coming out and we have an account with those being accumulated, investors get a certain percentage of that. On sale, they also get another certain percentage of the profits that we produce as well. So that's part of being a limited partner. Now, being not a equity partner, but being basically a debt partner, and he's not a debt partner like a bank where he's got a lien on the property, so he doesn't have a lien, but basically he's getting a preferred return, so a pref is what we call it, of 8% or whatever. So the lender gets paid first, then that guy gets paid first, and again, he gets a higher preferred return than all the other investors because that person's putting up a chunk of capital, quite a big chunk. They don't have security, but also they have given us the ability to be able to finance it. So long story short, that position that person holds is not subject to UDFI or UBIT tax because it's debt. Or he's a lender basically. It's not that he is participating in a deal on the LP side where the asset is debt leveraged. I don't know if that did an adequate explanation, but that's one thing I've found out recently that you can do. And so we do offer certain people to be preferred equity partners, for example, which is basically, like I said, another version of a lender. And then there's also qualified retirement plans too that exist out there to avoid UBIT tax. And then that's what I know of. There could be more out there that y'all know about, but those have been the biggest ones I've learned about.
Yeah, I've come across the same in terms of different structures that can help with avoiding being subject to the tax. I think what's important for this conversation is for those that are new to self-directed IRAs, just being aware of what that tax is, which you explained, and that unrelated debt finance income tax, which can apply to the IRA in association with a portion of earnings that are attributed to the leverage, right? So I would think too, in any documents that they're signing, there would be some mention of that it may apply. So those are things that investors should just keep in the back of their minds to look out for. And if they're looking at maybe restructuring or they're looking for some guidance, they can also speak to tax advisor or an attorney as well. But I think just for now, being aware of what it is and that it may or may not apply in those situations is important. So some of the other questions that we got specific to self-directed IRAs were sort of like, why would I use one, for something rather than using my cash? So I think the tax advantage is an obvious benefit, and we covered that pretty heavily already in this conversation. But some of the other things to think about when using a retirement account for these types of investments are one, diversification and hedge against volatility, right? So the markets have been nothing if not volatile the past year or two, right? It's been kind of a roller coaster, and it's just been a reminder that when we invest in public securities, we often don't have a lot of control over what's going to happen. But we work very hard for the money that we put into these investments and that we put into our retirement accounts. So we'd like to hope that we have a little bit more control, and being able to diversify and expose yourself in alternative investments. They tend to yield longer term, more stable returns. So that is a way to sort of spread out your risk exposure. Another thing is that with the ability to choose your own investments, if you're evaluating these different investments and you know what kind of return you're going to be getting, or you're already doing these types of investments with your personal funds, and you know that you're getting better returns than the market's yielding you, then you can apply this strategy, just simply apply the strategy that's already working very well to an IRA kind of vehicle. That's a good way to think about it. And that's usually when people tend to be very successful, is when they say, hey, I already know I want to do these things, or I've done these things very well, and I feel good about looking for deals, and I have some opportunities that I'm thinking about. Would this work in my IRA? And then, having a conversation with the self-directed IRA custodian about, does this fall within the IRS guidelines, and is this something that could be done? We talked about account types a little bit. Traditional tax-deferred IRAs can be self-directed. Roth IRAs can be self-directed. If you're a business owner or a real estate agent and you get paid on a 1099, you can have a SEP IRA or a simple IRA. Haley, you mentioned solo 401ks also for business owners, and those are a little bit more customizable for business owners, and they come with the advantage of not being subject to the UBTI or UDFI tax at all. So if someone qualifies for that, that could be something to consider. And also, you also mentioned other qualified retirement plans that business owners might have, like pension plans, defined benefit plans, profit sharing plans. If they already have them in existence and they're invested in public securities, but they're interested in maybe expanding their options to include alternatives, there are some questions they can ask of their plans administrator to see if that's allowable. And we can have those conversations to help guide them in those directions. We talked a little bit too about compliance. So custodian's role also includes, while the custodian isn't doing necessarily due diligence or endorsing from a legality perspective, the custodian is also responsible for making sure that the investment documentation that supports that, so in this case, it might be like a PPM or subscription docs or a partnership agreement that the investor would normally sign, in this case is going to be signed on behalf of the IRA. So the custodian would have to review those documents to see that investor is labeled as that long, nice naming convention, next generation as custodian for the benefit of John Smith's IRA 1234 is actually labeled as the investor. And then we're also looking for, do we see any disqualified persons involved that are noticeable on the documents that would present risk of a prohibited transaction? So all of those things needs to be taken into consideration and examined by a custodian before an investment transaction is processed. And that's part of the role. So the process usually starts with just opening a self-directed IRA, and I'm getting a battery low on my computer, which I normally don't get this quickly. So I may run upstairs or take a question. I think yours was contagious, and now I'm.
I think we might have lost her. Now she's frozen. I think that now that she's frozen, it might be a good opportunity to get through some of these polls. So,
what did she just end up saying? Like, so I can leave a note.
She was talking about the process. And I can actually get into that a little bit now. So the process, obviously, the first step is going to be opening an account. That can take
a scenario of literally I've got a Roth IRA, now what? Yeah.
So, well, it depends on how you're funding. So if you're funding from an existing like 401k, that can be rolled over. So obviously with rollovers, you're going to have to contact the custodian that you're with currently and obviously ask for that rollover. But with your self-directed IRA, the first step that you really want to take care of is getting the account with your self-directed IRA custodian open, and then they're going to help you with that funding process. So the account opening process will typically take anywhere from 1 to 2 business days, at least with us. That will vary from custodian to custodian, but generally it's a couple of business days. And then from there, our transactions team will help with the funding. So depending on how you're funding, you can cash contribution, you can roll over, or you can transfer. So like I said, rollovers are from an existing employer sponsored plan. So it's not an individual retirement account or an existing IRA, like at a Fidelity or a Charles Schwab. So that will be done taken, with a rollover. Otherwise, it's just going to be a transfer. And that can take, we typically will say anywhere from 4 to 6 weeks, because it's going to depend on the custodian that you're either transferring or rolling over from, and what their requirements are, what their processing times are, things like that. So it'll vary, pretty much on the custodian, but typically 4 to 6 weeks. So if you have an investment in mind, we really like to stress that you get that account open first so that you can start that process, because you cannot do anything with the investment until your account is open and funded. So once you're open and funded, then you're good to go on the investment process, and that will take anywhere from, I would say, 1 to 2 weeks. As Brittany explained, we go through an administrative review, and that's just so that we can identify any risks for prohibited transactions. And then there's obviously the processing of the transaction, which needs to go through its own review process in itself. And that usually takes about 2 business days, 2 to 5 business days. So in all, for the entire process, you're looking anywhere from 1 to 8 weeks before you can actually do something with your account. So just bear that in mind. But obviously, like I said, what was that?
I think it's really smart to go ahead and just open your account ASAP. Like if you have a retirement account and you're interested in investing in gold, real estate, whatever that's going to get you a better return than you're currently getting, just open up the account. Because like you mentioned, if it's an 8-week process and you get it started, our closing can be as little as 30 days. And it's usually about 60. So I usually do due diligence for about 30 days, don't tell anyone the numbers yet. And then once that's done, I go, okay, we're ready to launch the investment. And then now we have like 30 days to close it. You know what I mean? So we ain't got time for that. Ain't nobody got time for that. So it's just better to just set it up right away. I'll tell you the truth. That's from my frustration, from my side of things, the way that I see it. And I hate having to push additional pressure onto investors. They've already spent their time to do the due diligence, talk to me, gone through whatever they need to do on their end. And then now I got to be like, okay, now you got to call them. Now you got to get a check. Now you got to rush it over here. Now you got to rush it over there. Then you have to, and imagine me doing a deal where I've got 100 of these coming in. Impossible to coordinate all of it. You know what I mean? So again, just open your account now, and then you will find a deal within a couple of months. I promise you, if you're looking.
Britt, while you were gone, so it's okay. We talked a little about the process, obviously getting your account open, how long funding may take, and then, making the investment process and what that looks like. So before we hop off, obviously I want to get to some questions, but first I want to get through some of these polls. So there's a couple
so many.
There's a few questions. Some of them we're not going to get to today, but obviously, since it's being recorded, we have everyone's information. We know what you're asking. We're tracking it. We can always get to it offline if need be. But we do have some minutes left, so we'll get here through the polling. We just want to learn a little bit about you guys. So our first poll is, what types of retirement accounts do you currently have? So you can select any, one or all. But we just kind of want to know where you're at now, what you have going on, and what you may be interested in opening.
What you working with?
Guys, a few seconds while these roll in.
Yeah, that's right. You can do a 403B, pension, SEP, solo 401k, HSA, TRS, teacher retirement savings. I mean, all the things.
Alrighty, I am gonna get this one closed out and we'll share the results. So it looks like the majority either have a traditional or a Roth, followed by an employer-sponsored plan like a 401k, SEPs, solos, and then others. So that is interesting. Quite a few of you guys have either HSA, ESA, or a qualified plan. So our next poll, which I'll get to, is what is the balance of your retirement account or retirement accounts? And this can be cumulative. So I'll launch that poll, give you guys a couple seconds.
I've got a couple of lenders we work with that actually have millions in their IRAs, which I was surprised. It's awesome. Because they lend out money and then put it back in, lend it out, put it back in, just like, we do with our deals.
Alrighty, we'll close this one out. And let's see what we got. So it looks like we have the majority have anywhere from 50 to 250K. Some have at least 500 to $1 million or over $1 million, so that's great. And then a few that are either under 50K or between 250 and 500. So definitely a good mix here.
Something I want to say about this too, and I know Kayla, you and I have talked about this as well, is like sometimes the misconception tends to be I have to have $500,000 in an IRA to invest in real estate, and that's not the case, right? Because you don't have to be the sole owner of a property, nor do you even have to invest directly or actively. So like the things we're talking about today, like limited partnerships, crowdfunding, syndications, some of these have minimum investments of, I don't know, what are some of the ones you see, Kaylee, like 10, 15,000 or more, or what do you say?
Talk in terms of minimums, but for example, what's typical for a accredited investor, they usually invest between 100 to 250K or so. Typically an unaccredited or sophisticated investor will usually be either doing it for their first time or typically in 50K increments, which is the industry average. Then I have a crowdfunding offering where basically it's like, all right, you got less than 50K, what do you got? How can we work with you? So we've had people put in 40, 13, 25. It's capped by some rules by the IRS. Basically, if you make under $107,000, it's based on the higher of your net worth or liquidity. So you're capped. So basically, it just depends on like what do you have to work with. Let's talk about it. So I just opened up that crowdfunding offering for all those ladies, particularly who have not put money aside to invest. They've saved it for other things, or they have donated it for other things. But yeah, so it can definitely vary. Just so we can work with you, or other individuals that are maybe like Reg A plus offerees. They can work with you too.
Yeah, and it's never. So there's no excuse like not to try to get started, because these people that have millions, we shouldn't assume that they have it just because it was, already there. They may have strategically invested, a smaller amount. And as Kaylee said, you invest, you get money back. You reinvest it, you get money back. The power of that over a long period of time can take you places.
Velocity of money, just take advantage of it. And you already have these IRA accounts, and I've got some people who their employers have matched them too, so yeah.
Yeah, so there are a lot of ways to think about this outside the traditional box that I think a lot of times we've been like conditioned to think about.
Yep. And we had one more poll, but I do want to get to questions. It's not as relevant, but I did want to just kind of get a feel for what types of investments you guys are interested in. So we're not going to get to that one today because I do want to get to questions, but I would encourage you to just think about that. Because
let's do it. I think we should do it real quick. Can we?
Really quick.
Sorry, I'm going to be that person. I see
Self-directed
most of the people are still on with us, so I didn't want to lose.
So self-directed IRAs will allow you to invest in non-publicly traded alternative assets, which include real estate, like we're talking about today, but other things like private equity. Cryptocurrency is very hot right now. Precious metals has been hot recently. Lending, and that doesn't have to do with anything with real estate, but if you want to, lend, your funds to a friend or something like that, then that's possible as well. So we just kind of want to get a feel for what types of investments you might be interested in, whether it's real estate or something else. So we'll launch that right now. And then another one that I actually didn't mention, which is on the list for impact investing in social causes. So if there's something that you guys are very, very passionate about, as long as it's a private entity, then you can invest in it.
That's pretty cool.
Yeah, we're seeing a lot of that lately. That's really taking off.
Some things that might fall under impact investing, like the ESGs, the environmental social governance, those types of things. Energy investments within impact investing are popular, like solar stuff and things like that. Social causes like the Black Lives Matter movement, or anything related to oppression, things like that, if there are any investment opportunities. We did a blog post recently on Broadway, people that like to invest in Broadway shows, off-Broadway shows, or even off-Broadway shows. So those are other different types of unique investments that are also, within the realm of what you can use your self-directed funds for.
That's right.
And in that case, go ahead, Kelly.
So that's right. People can invest in what they care about, and shameless plug, when we're done with this, y'all go check out my website, because we are empowering women to financially take care of themselves by not necessarily requiring, you only have 50K. That's the minimum that you can invest otherwise, so we've lowered the barrier to entry into these cash flowing deals and their physical assets. So over time, when it is like real estate, or I don't do gold, but a physical asset, over time, it's still going to be there. You know what I mean? So even if there's issues, it loses value, you can still have the physical asset to sell off. It doesn't just overnight lose value. So being able to have people or ladies invest into things that, are real, you can touch it, you can taste it, you can see it, and it's not going anywhere, especially housing that, people need a roof over their head and demand is high. That's one way to be able to empower females that are leading the deals, and then also ladies that are investing, and also our men that invest, they pick a female mentee. But you can check out more about that on our website, exactly how that all comes into play and how it helps to get more of a certain category into commercial real estate who are not currently there right now.
Awesome.
Guys, a couple of quick questions. I wanted to spit off some answers. I know we're kind of like done,
Yeah.
but someone asked, can a foreign investor invest? Yes, the best and easiest way to do it, go set up an LLC, a US-based LLC, open a US-based business account, bank account, and then boom, easy, done. Another way that people are wanting to know about more benefits of multifamily investing, there's a variety of them. Diversification is one that's huge. Multifamily are multiple units, and so it's spread out. For example, if we have 10% vacancy, it's not that big of a hit because there's so many units. Then also we take advantage of downturns, again, like I mentioned, because that when downturns happen, people don't go invest into single family homes. They move into apartments. If things don't go well, they move into apartments. So that's another way. And then also investing through a sponsor can provide a level of passive income with less risk than a stock or a bond. And there's many different answers to that question. I'm happy to take this offline to answer all of them. But one thing I forgot earlier was a thing called bonus depreciation that you also get as a tax advantage as being a part of a multifamily investment. So what that means is we take all the depreciation from the asset and take it in year one, in addition to your normal depreciation. So you can't do that with a single family asset, but you can with commercial. And so, for example, that will just get you, like, we had a $2.5 million purchase last year, and we had $900,000 in year one bonus depreciation spread to all of the members in the company. So that will end in 2023. So, and then it will be, not end, but it will start going down. So as of now, we can take that all. So now is a great time to invest in the multifamily sector, because that's, or commercial real estate sector, because that's available. And then last tip, You can do an in-service rollover if you are currently with an employer. Not every company will allow that, but if you ask them, so you don't have to maybe wait until that job ends. Maybe you wanted to be there for your entire life. That's okay. So just figure out if your employer will do an in-service rollover. And then there's another little trick that we have an attorney that can help with this. There is a 401k and other retirement transfers that can be that can happen pursuant to a divorce, and it's non-taxable. So there is a way in a document that we can put together if you're not getting a real divorce, but it's a document where we can make a transfer non-taxable from husband or wife's IRA that's active, pull it out and be able to use it to invest. Teacher retirement accounts, there's all kinds of ways to do stuff. So cool little tip, and then I'll stop.
Thank you. I think you actually covered, I'm going through the questions, you covered a lot of the answers, but the one that I wanted to touch on really quickly was, where does one find info on fees and admin of Next Generation Trust Co? So to answer that question, it's pretty easy. Just head on over to our website, www.nextgenerationtrust.com. And on the top navigation on our website, you'll see a little button called Forms. If you go to Forms, you just click that button. It'll take you to a box of forms that we all have. I think it should be under fee information, and then you can download our fee schedule from there. No hidden fees, nothing, that we charge that's not going to be on that fee schedule. It's all there, and you can download it from our website. But also, if you have any other information or any other questions, feel free to email us. I'm actually going to ask Britt and Kaylee, if you can, please just paste your contact info into the chat box so that everybody has it. And then once you guys do that, let me know and we can wrap up.
Let me know if you get it, because it still only says that I can send it to organizers, presenters, and panelists. So I'll give you all my email, and then I'm going to give you a link. Let me see if we get that. And then I'm going to give you a link to get qualified for our next investments as well. Let's see if that goes in there. Some people did ask, like, let's talk about returns. Let's talk about the investments. So I can't do that on a educational webinar. But obviously that's the way to go find out more info, and we can talk about that offline.
And Britt, did you get yours in there?
I did.
Then we got Britt. I'm just making sure this gets out to everyone because it looks like it was to organizers and panelists.
Sure.
Yeah, Britt, and then our.
Oh, to all. Yeah, I can't do that.
Yeah, I don't know why. For some reason, GoToWebinar is just a little weird, and I guess I'm the only one that can chat the audience as the organizer, but who knows?
Yep.
So for anyone, the information is pasted into the chat box, which you'll find on your GoToWebinar control panel. Should be on the right-hand side of your screen, and it's going to be the chat widget or the chat tab.
Do we also want to drop our link to schedule a complimentary educational session?
Let's do that. So it's on our website, but also I'll just drop the direct link. You guys can schedule a complimentary educational session with one of our IRA specialists. They'll essentially just walk you guys through the whole process and just kind of determine where you're at and how ready you may be to open a self-directed IRA, and discuss some of the investment options and what you might be interested in and how that might work. So it's a great opportunity for you to get some one-on-one time with us and figure out if this strategy is something that might work for you. So I'll get that into the chat as well. And with that, you just fill out a form, and then it'll take you to a page where you can schedule that time as it works for you.
Perfect.
So I guess
Awesome.
With that being said, that'll conclude today's webinar. Thank you to everyone that stuck through our technical difficulties. We'll try not to do that again, but as always, it's 2021 and anything can happen. So we'll see you next time. Thank you for joining.
Thanks,
y'all.
Kaylee, for joining us.
Today.
Take care, everyone.
Bye.